Hello guys, my name is Mubashir and today we are going to analyze the pharmaceutical industry in which I have selected Glenmark Pharmaceuticals Limited. First of all, I am new and you can say that I don't have that much knowledge about the analysis, stock analysis. So you have to take it like that. So let's start the video. Glenmark Pharmaceutical Industries. Let's see about what is doing actually. Pharmaceutical global research. It is a pharmaceutical company. As we know that it operates in 18 countries approx, and it is a 14th 14th largest and fastest growing in the Indian market. Okay. It has a we can say that if we split its business into a geographical areas, that we can say that it has a 25%, but majority we can say that majority of the its contribution goes to the 25%. Majority of the its business like one fourth of the its business conducted in the India and in the North America, and then Europe and ROW and Asia. Okay, so let's start with the basic ratios. Actually, I am learning too. That's market cap is 62,000. That we can say that it is a large cap. Okay, current market price is 2200 approx, and return stock P is 47.4. And if we compare it with the industry P, then we can see that it is a 33. That means 10 times more as compared to industry P. Return on capital employed 19.4. Return on equity, that is 15.8. That means company have depth in its capital. Promoters holding 46.6, and there is no change in promoter holding. That's good sign. Interest coverage ratio is approx 10x of it is EBIT. That's great. APS growth is 10.8, 11.8 of 5 years. That's quite good. That, and if you see that for 10 years it is around 17%, which is great, as it is a capital intensive industry where they have to incur a huge expenses for the research and development. And quick ratio, it is 1.05. That is nearly equal. We can say that it is a fair, but it can be more good. And current ratio is 1.56. That indicates they have inventory in their stocks. Okay, pledge stock, there is no pledge stock. That's good sign. Book value is 314, and the current market price is 214. That means it is around 8 times price to book. 7 times book value. Current market price is 7 times as compared to this book value. Debt to equity ratio is we can say that they have a more equity as compared to debt, but yes, they have debt. It's not a debt free company. Sales growth for the 5 years is only 4.6%. That's quite low. Dividend yield simply shows the how much dividend is how much percentage of dividend as compared to this current market price is given as a dividend, which is 0.11%, or it is most likely 21 rupees. Like, okay, face value is 1. EBIT to EBITDA means companies how much companies value how much times companies value as compared to this core profit, that is 25 times. That's too much high. PEG ratio is also is high. It should be around 1.5 or below the 1. It is will be better, but it is 4. That shows that the company is not growing that much as compared to it is P is growing. Let's see. It is stock price from 2010. That it was there about 300. Now it is around 22, means 7 times worth. Let's compare with the P. Okay, looks like fluctuates too much. There was a time when they were having 41 P with the EPS of 25 approx, and looks like it is actually on a medium scale. There is no change, we can say that, but the price is continuously increasing. That shows that it is overvalued stock. The median P is 20. Let's compare with its peers. So basically the Sun pharmaceutical industry is at the top, and it comes at the 8th by the market cap. We are not going to compare the net profit because we cannot go with the numbers. We have to check the percentage or ratios. Quarter sales variance, it has a low quarter sales and also high PEG ratio, means the stock price going too fast as compared to its profit. EPS score, we can say that. They also have a low EPS as compared to industry peers. Sales variance also low. Profit variance 5 years, it is quite low as compared to other peers. Interest coverage ratio is also low. Current market price to the book value is we can say that it is average. PBT EBITDA, it is also high, which is a bad sign for the company. Current market price to the sales, means for each sales how much for each rupee of sales how much investors are willing to pay. That is 4.7 around. Return on equity, we can say there's near approx near below the average, industry average. Return on capital employed, we can say that it is also below the industry average. Debt to equity ratio also bad here. So let's analyze the quarterly results. So the March 22 and the March 25, in this 3 years, it is growth. It looks like it is stagnant. There is no much that much growth. Okay, expenses, let's see if they have improved their efficiency or not. Looks like they are it is fluctuating, but at the end it is stagnant. There is no change here also. And employee costs look like the employee cost is increasing over the years. Operating profit look like they have improved their operating profit margin from 15% to 17%. Other income, there is interest obligation. They have slightly improved here. Depreciation look like they have stagnant here too. Profit was stagnant too, but it was slightly increasing here, but suddenly it is dropped here because maybe they have done some kind of deferred tax. They have paid maybe a deferred tax and something else, maybe any contingencies. Net profit is quite stagnant. There was no net profit has been increased here, but before that we can see that there was a huge loss here, which is covered by here. Therefore we can say that it is a negative sign too, because there is no improvement in profit. Even we can say that they are making losses here. If we combine that, that is around 1500, and we combine here it is around 700. Means they are still in a loss of 750. Let's see the profit and loss account. We can say that they have doubled their sales from 6,000 to 13,000, more than double, we can say that. But it is during the duration of 10 years. Expenses, material cost has been increasing. They are means they are not getting the advantage of economies of scale. Material cost, like raw material cost has been increasing, maybe because of the government taxes or the inflation, change in inventory. They are reducing their inventory, means there is outflow of that. Manufacturing cost has been stagnant. There is no improvement. There is no efficiency improvement there. Employee cost also been increasing. Operating profit is doubled to more than, we can say that doubled. We can say that it is 120% improvement in the operating profit margin. Same, there is no improvement. Other income, exceptional items, and other interest obligation has been stagnant, but there was a slightly increment there. There was a increase in interest obligation, but at the end it is stagnant. Profit is also doubled here. Net profit, if we can say it is offset, but there is a still loss of around 400 crores. EPS, we can say that EPS is also doubled. There is a no overall profit and loss statement and quarterly results shows that there is a no improvement in companies being in a stagnant position for the 10 years. There is a weak, or even it is going below. It is not in, we can say that it is being stagnant with, but it is it is not improving. It is efficiency after even after the 10 years. It shows very bad quarterly results and profit and loss statement. Let's go with the balance sheet. Equity capital looks like they have risen in 2016. They have issued more shares to raise money. Reserve, let's see reserve. It is 3 times, across 3 times. They have improved their reserve slightly. You can say that. Long-term borrowings, looks like they have reduced their long-term borrowings. That's a very good sign. That's very good. Short-term borrowings, looks like they have increased their short-term borrowings, but reduced their long-term borrowings. Lease liabilities, there's no problem with that. Other liabilities, non-controlling interest, okay, there is no. Trade payable has been increasing over the years. That's a bad sign because they are not paying their creditors. Let's go with the assets. Land even reducing, means looks like they are selling their land. Buildings, at least they are purchasing buildings, more and more buildings. Plant and machinery, they have looks like they are actively investing in the plant and machinery equipment. So looks like it is been stagnant. Furniture, okay. Vehicles, there is no improvement. Intangible assets, looks like they are purchasing more and patents and all. Gross block, okay. Accumulated depreciation is around 50%. Looks like it is a 50%. Capital work in progress, there is still a capital which is in work in progress. Investment, looks like they are doing huge investment. They have done huge investment in 2024. Their inventories, looks like their inventories have been increasing over the years. Trade receivables, Receivables over the 6 months, it is quite low. That much is not that much pressure. Receivables under 6 months is that's a good sign that they are going to be recovered within a 6 month. Are they creating any provision for that? Yes, they are creating the provision for that. Cash and cash equivalent is looks like they are having it cash too, loans and advances. Okay. The balance sheet is overall is a good sign, showing a good sign for the company as they are actively investing in the business. They have increased their investment in plant and machinery. That's good sign. But let's see cash flow. What cash flows are telling? Are they really doing that or just showing in a balance sheet and a profit and loss? Let's see. Receivables. Looks like the receivables has been increasing over the years. Okay, that's sign. Inventory is reducing. That's a good sign for them. Payables. Okay, they have recently paid their debt creditors. Okay, that's good. Okay, working capital changes. Okay, direct taxes. They are paying the fixed asset purchase. Yes, that's the thing. Activity from cash from investing. Okay, they are actively purchasing fixed asset. Investment sold, yes, they are a little bit, they have purchased investment sold. Maybe they sold some kind of subsidiary recently. Interest received, they may be having some kind of fixed deposit or their dividend receipt. Okay, mention other investing activities items. Now analyze the cash from financing. Let's see if how they are raising their capital. Proceed from shares, as we observed that in 2016 they have issued more shares to raise the fund around 1000 crores, and then redemption of the ventures. Okay, they have recently redeemed their ventures. Proceed from borrowings, they have borrowed more and more funds recently. Repayment of the borrowings, they have borrowed the funds and they have paid also. Okay, interest paid. Looks like they were paying the interest burden has been increasing over the years till 2024, but after that in 2025 they have reduced it. Financial liabilities. Okay, debtors. Okay, debtors, that shows that how much time debtors take to repay the company. Looks like it has been increasing over the years. Okay, there was fluctuation also there here, but it is increasing. Inventory days, it shows that how much time it takes to convert inventory into the cash. It is quite increasing. That's a bad sign. Days payable, it is shows that how much time companies takes to repay. It is creditors. So looks like also in stagnant. Okay, cash conversion cycle simply shows debtor days, inventory days plus minus payable days. It looks like it simply shows that how much for how much days companies capital stuff. Let's because if companies taking any material or something that they use to build any product, if they are taking a credit of let's say 100 days, and the debtor takes and they make the product and sell the product within 20 days, and debtor takes 20 days to repay them, means inventory days are the 20 days and the debtor days are the 20 days, means they are getting extra 60 days grace period. uh, Within that they can pay their debtors, means there is no cash block which is happening towards the company, means companies don't have to pay in advance to the creditors. So it is a good sign for them. Till it is a positive, looks like they are getting a positive debtor days, and it's been good for the companies over the years. Debtors, inventory days, and days paper. Okay. Working capital days and return on capital employed. It's like slightly. Let's see the what's promoters are doing over the years. Looks like promoters holding the shares, they are not selling it. It shows the confidence towards the company. Foreign institutional investor. Let's see what foreign institutional investors are doing. Looks like they are not selling it all. They are also holding. They are not doing anything with that. Domestic institutional investors also increasing their stake in the company. Government recently looks like the government also purchased the public. Look like public is losing their confidence in the company. Let's see the recent news by the company. Announcement under the regular Glenmark Pharmaceuticals received a US FDA warning letter. Looks like they are getting the warning from the FDA, which is in USA. Okay. They recently announced the meeting of the analyst, announced it on the regulation. Let's see the important news only. Okay. IGL licenses ISP 2001 to ABI for 700 million dollars. Okay. Let's see, are there any recent resignation, so that we can see what's happening. The company announcement and the was happening in the announcement under the change in management. President has been resigned since many reasons. Okay. Appointment. There is no recent important news except this warning. This warning letter. But so overall, my recommendation looks like the company is not doing that much good, but the shareholding shows that the promoter still hold promoters still have confidence towards the company. FIs also have a confidence, and DIs also. But the public don't show. The public, it looks like public are losing interest towards the company. Also, company is not doing that much good, and it is also overvalued as compared to this P and the current market price, book value, and all. So I can see that it is better to avoid this company for now.